Jim Bullard is the former president of the Federal Reserve Bank of St. Louis. He's one of the nation's foremost economists and respected scholar leaders. In August of 2023, he became the inaugural dean of the Mitch Daniels School of Business, reimagined at Purdue University. We're going to talk a little bit about why he took on that challenge and what the Mitch Daniels School is and why it is so special. He has, in his 15-year tenure as the president of the Federal Reserve Bank of St. Louis, it made him the longest serving Federal Reserve Bank president in history. He's part of the Federal Open Market Committee. He earned significant praise and accolades for his long-standing leadership and innovative thinking, helping to guide the direction of U.S. monetary policy, which we also know influences global monetary dynamics and policy, recognized as one of the 10 most influential economists of the world. And we are lucky to have an opportunity to interact with him. We did get that chance a couple years ago. He was born in Wisconsin, grew up in Minnesota, earned his bachelor's in economics and quantitative methods and information systems at University in St. Cloud, Minnesota. He received his doctorate in economics from Indiana University in Bloomington, a true Midwesterner. And we want to thank you, Jim, for being here with us. I know you've got a lot of demands on your time, and we really appreciate you spending some of that time with us. Welcome.
Oh, it's great to be here. I'm looking forward to the discussion. Should be great.
Awesome. I'm going to introduce Eric in a moment, but I just wanted to open up with just a few questions for you before we get into the real meat and the nitty-gritty of the actual topic here. Maybe you should just tell us a little bit about you made this transition from, say, the public sector of Federal Reserve, and you joined the reimagined Mitch Daniels School of Business. I thought maybe if you could just share a few highlights about what attracted you to this opportunity, what are the strengths, what's unique about the program, why did you choose Purdue?
Yeah, I mean, Purdue is one of the premier technical universities in the U.S. The engineering school on campus, which is very much the biggest, is ranked number 4 in the nation. So it's MIT, Stanford, Berkeley, and Purdue. But Purdue is much bigger than all of those. Purdue will turn out more engineers this year than anyone in the country. So the idea is to grow the business school, which has been here for a while, but and it's good, but grow the business school to a larger size and intersect more effectively with engineering and with our science group, which is also very good. And so by doing that, we're going to create a distinctive brand around the Daniels School, somewhat different from some of the other business schools around the country. And we certainly have many dimensions on which we're doing this. We've also got a freedom and capitalism component. We've got the econ department here in the business school, which is different from some of the other business schools. So lots to like and lots of good things going on.
Great. I mean, it's just, if you don't mind, just like building on that a little bit, you've got a great business school, you've got a huge scale in engineering, this third leg of technology. What about those 3 legs allow you to differentiate the program from others? And I guess a question for me is it more about that these 3 things or the capabilities of Purdue allow you to differentiate yourself, or is it that these are things that leaders of the future need? Is it more kind of supply driven?
Oh, it's absolutely a vision of what the future of business is and what the last 25 years has been. I've said technology ate the business world quite a while ago, but that's going to just accelerate even more going forward. And I think there was a time in business school education where you teach people that you're just going to produce something and this is all about managing that process or getting the financing behind that process. But these days, I think it's become very clear that if you don't know the technology, you can't really run the business. So you need people that know the technology and know the business. And so you need both dimensions. That's been around for a while, and other business schools probably say they can do that, but we have a lot more credibility on that than most. And I think this will enable us to push forward our integrated business engineering program, integrated business and science program, and including computer science. We got major gifts from the Lilly Foundation here now, close to the top 10 in market capitalization in the country. So we've got a lot of support
Mhm.
and a lot of enthusiasm. So it's really been fun so far.
Amazing. Yeah, so many places we could go with that. I'd love to explore kind of what this future of work might be and what the future needs are. But I want to step back. I want to let you and Eric Goldstein have a conversation. Eric is was the chief strategy officer, now the chief growth officer of TIAA. He's responsible for working with senior management there to shape the creation and execution of TIAA's corporate strategy and development efforts. Before TIAA, he spent 20 years at JP Morgan as managing director and head of their North American insurance mergers and acquisitions practice. Before JP Morgan, he was a consultant at McKinsey in the firm's financial institutions practice. He has a JD from Yale Law School and his undergrad degree from Harvard University. He's been a longtime member of Outthinker's Chief Strategy Officer Network. His father was a very well-known, renowned economist as well. And we're excited to have you, Eric, join us here. And I am going to disappear and I'm going to let you guys have a conversation and I'll come back towards the top of the hour. Thank you.
Well, thank you. I feel really privileged to be able to play this role here with Jim. We're very lucky to have you, Jim. So look, I thought what we want to do is, like, I think for this group is paint a picture of the current, economic political moment we find ourselves in, which is a pretty fascinating one. And I think we can do that by, covering three areas. One is, your view of where we are in this macroeconomic moment, the U.S. and relation to the world. Then we could add the political context. Obviously, we have a new administration starting any day now with very I would say an agenda that has been spoken about, particularly around tariffs and immigration and taxes. So we'll talk about that. Add that on to the economic moment we're in, and then finally, I think, add the context of, any political administration inherits a monetary and fiscal situation that they can't avoid. And so we'll add that on top of it. And collectively, I think when we go through all of that, I think there'll be a really good picture for this group on we are and where we're likely to go. So with that, why don't we just dive in? Jim, just ask an open-ended question. So where do you think we are macroeconomically here in the U.S. and in relation to the rest of the world? How would you describe the start with this new administration?
Yeah, I mean, I think the new administration is starting with very good initial conditions for the economy. So let me describe that a little bit. If you track the economy every day over the last 3 years or so, you know that since the summer of 2022, when the Fed started really raising rates a lot, there have been predictions of imminent recession in the U.S., most recently in the July timeframe this past year. None of that happened. The last 10 quarters of growth rates have all been over 2% except for one quarter. And there really hasn't been anything even close to recession during this last 10 quarters. So that's 2.5 years of above trend growth in the US. And now you've got a new administration coming in, which is probably more business friendly, more growth oriented, and wants to implement policies to even build on the 2% plus growth that we've had. So we'll see if they can be successful or not, but they're basically in very good starting position. The labor market also has done very well. Again, there was a little bit of concern just this past year, but that turned out to go away in the data that came out in October, November, December, and the most recent jobs report. So we really have got unemployment very close to what many people think is the natural rate of unemployment for the U.S., low to mid 4% range. You've got, continued economic growth. On the labor market, though, you've got other indicators of labor market performance, which are also doing very well. So even if you don't want to just look at the unemployment rate, you can look at many other things, job creation, many others, and you'll get a very good picture of the labor market. So that's good. You've got inflation. Inflation has been the main story for the Federal Reserve over the last 2.5 years. It's been an amazing policy experiment and a successful one that brought inflation down. On CPI, headline inflation was at one point over 9% on a year-over-year basis. Now, I guess after yesterday's report, running out, in the low 3% range. So, 600 basis points on inflation reduction without having a recession. So that is one of the most successful monetary policy moves that we've seen in the whole post-war era. And I think what's happening today is that you're seeing interest rates realign to a steady state growth scenario or an above trend growth scenario. And what I mean by that is you've had this inverted yield curve over the last 2 years because you had this prediction sitting out there that the U.S. would soon go into recession. None of that happened, and now people have given up on that with the new administration coming in. So now you've got an upward sloping yield curve, and I think there may be a steeper yield curve ahead. Some of that will come from the short end going down a little bit more as inflation continues to recede. And some of that is because the long end of the curve probably needs to trade in the 4.5% to 5% range, or even a little above that, even in normal times. So given this constellation of data. So I think that's a lot of what's happening here is that bond markets are reorganizing their thinking about what the prospects are for the U.S. economy and what the prospects are for inflation. And that's all taking place on a daily basis. So maybe I'll stop there and not go on too long about this stuff.
So I two questions come to mind out of that. One is, so where do we sit in relation to the rest of the world? Like, how does the rest of the world think about us and how we're doing relative to them? And how Europe and China doing affect all of this?
Yeah, I think there's a lot of talk about American exceptionalism. I've never really known what this phrase was talking about, but at least in this context, you can give it pretty clear meaning. U.S. is growing for a big, successful economy, is growing pretty rapidly. Europe is having much more difficulty, in Germany in particular. If you check the FT today, there's long on what's wrong in Germany, but I guess they'll have 2 years in a row of contraction now, and they're the engine for European growth. They've got some success elsewhere, Spain, but basically Europe is not looking very good from a growth perspective. Their inflation situation is under better control, so they've got a lower interest rate environment that's putting downward pressure on the euro, upward pressure on the dollar, so you've got this strong dollar situation. I think for Japan, that means a weaker yen and a stronger dollar. But I think pretty clear that the Japanese feel that 160 is too far on yen dollar. So I think they've gotten more hawkish as well as the yen has weakened to these extraordinarily low levels. And then China, I think, is having trouble, but you should keep in mind that's still an economy that's growing faster than the U.S. The fastest might be India over the next couple of years, but faster than we are, but not as much as before, and certainly with a lot of clouds on the horizon. We could talk about it, but many types of problems that need addressing. My general feeling on China is that they're headed for a middle income trap, and we can talk about that in more detail. But so, given that constellation, people are saying, well, the U.S. looks really good. I would say one other thing that you should keep in mind, and you all know this, but the rest of the world's not doing that well. A lot of our corporations are deriving a lot of their profits from the rest of the world. So it's not all good news. You'd really rather have everyone humming moving on all cylinders, and we don't have that in that situation. So the extent the global situation is a little bit weaker, that would a minus for the U.S. outlook, even though I gave a lot of bullish factors here.
Excellent. Okay. We could talk about the global economy for the rest of this conversation. So a good kind of like starting point where we are. Let's talk about the most obvious thing. We have a new administration starting in a couple of days. That administration has lots of goals. As you pointed out, a lot of it are around growth, lowering taxes, deregulation, but also a lot of it comes into conflict with other goals like lowering inflation and the like. So it's interesting no matter what happens, right? So why don't we talk about that? Why don't we talk about what you see as the goals, what really are the goals? Obviously, there's a lot of talk, but what you think really are the goals of the new administration when it comes to the most important things as affects the economy, and what realistically do you think will get done? And how will that affect the economy?
Yeah, I mean, I really do think the overall goal is economic. And the first Trump administration did have success on this dimension. And I argued at the time that the lowering of the corporate tax rate, which was accomplished in a bill passed in late 2017, did exactly that. A lot of that was anticipated as that bill moved through the Congress and was eventually approved. But the U.S. capital gains tax rate had gotten out of line with internationally because a lot of the other countries had made adjustments and we hadn't made any adjustments. So even the Obama administration had proposals to lower the capital gains tax rate, but they didn't want to go as far. And then when the Republicans came to power, they were able to push it down quite a bit. So that does revalue, the U.S. corporate sector up, and you certainly saw that during that period. Now, what's happening here is that you can't play that trick again unless you're going to go down to an even lower level of the capital gains tax rate, which wouldn't rule out entirely, but I don't think this Congress will be able to do that. And what they're talking about is really extending the other parts of the tax cuts that were implemented previously. That's not going to be that stimulative. That's just maintaining the existing law the way it is. So, and there's going to be a big lift just to get that to happen, to get those reauthorized. So I don't have quite as much, the policy that has to go through the Congress won't pack as much of a punch as it did last time around, because I really think it was the capital gains issue that was the biggest one. So that's one thing. I think a lot of people have talked about tariffs. Let me push back against the idea that tariffs would be inflationary. I don't think that's a good model of inflation. If you study monetary economics for 30 years, you could all these books and you wouldn't see tariffs even mentioned. So it's just not a good way to think about where inflation is coming from. Inflation's up to the central bank, and the central bank has to have an interest rate policy that's reacting appropriately to current developments in the economy. If you do get any impact out of tariffs, it would be a one-time impact, and usually the central bank would look through a one-time impact on the price level as opposed to ongoing changes in the price level, which is what inflation is. So I don't think you're going to get an inflationary impact, and you certainly didn't in 2018, 2019, which is the last time we had a sort of ramped up trade war, especially with China. So, and we can talk more about tariffs, but I just think the whole narrative that that's the main driver or a main driver of inflation, I don't think that's the right way to think about it.
But what do you think realistically they want to do with tariffs on day one, and what do you think the economic effect is then? If it's
This is
inflation,
about using tariffs to get other countries to do what you want them to do. And it can be, frankly, it can be a good weapon. I think here's one thing for this group. I mean, who's protectionist? Is Trump protectionist, or are the other countries protectionists? I mean, average tariffs are higher for the Euro area than they are for the US. Why? Why aren't the same? Tariffs are much higher for China than they are for the US. Why? And look at India, it's notoriously protectionist economy, much higher tariffs. So why isn't the rest of the world as low as the US? And then, as soon as you start talking about this issue, all of a sudden you get labeled as a protectionist. I don't think that's what's going on. I think you're trying to get them to come around to the idea that they should compete on a level playing field internationally. And if they're not going to do it, then maybe the US should have the same level of tariffs as these other major blocs have. I think it's a perfectly fine thing to think about and work on. The US agenda was always, because the interwar period had tremendously high tariffs. And so once you got after the war, the idea was, well, let's bring that down and expand world trade. But the US went down faster than all the other countries. And now you're 75, 80 years, after the war, maybe it's time to, revisit this and think about, what would be a realistic tariff structure now that everyone's had time to adjust post World War II. So I'll maybe stop there for now.
So, so we talked about taxes, we talked about tariffs. What do you think with immigration and you talked about labor markets? What do you talk about?
Actually, I'm going to go back to tariffs. I do have a scenario for you that I don't know what's going to happen. There are three things that could happen. And I'll describe these. These are very broad scenarios. So when people are talking about terrible things happening, that is a possibility. And it did happen historically. It was Smoot-Hawley. It was during the Great Depression in the US. And basically, the US erected major trade barriers, and everyone around the world responded by also erecting major trade barriers, and global trade collapsed. And this contributed, or some people say caused, the Great Depression. And the Great Depression is a phenomenally big event macroeconomically, both for the US and around the world. So there is certainly a very dark scenario. I'd put only 10% chance on that. That would be, I think that happened at that time in a kind of a different world than what we live in today. I don't think anybody really wants to go to that extreme. Another possibility is that the US, you get more like 2018, 2019, where you do get maneuvering back and forth, especially between China and the US. And then they eventually come to a deal of some sort, which is what happened at that time. I think the risk there is not inflation. The risk is that if markets get the idea that the rules are unsettled. I'm unsure what the rules are going to be, not only for the US and China, but all around the world. I mean, who wants to make $1 billion investment when you're not sure what the tariff rules are going to be? So everyone pulls back on investment. That's an effect that occurs immediately. So that's not something about, lagged effect over the next 5 years or something. That's right now. That's, I think, what happened in the 2019 as the trade war was rhetoric war was going on, and the US economy slowed down. The Fed reacted to that by lowering interest rates, and we did not get inflation out of that. So that's really the risk, is the most tangible risk, I think. I'd put 45% chance on that. That still leaves a big chunk of the probability. The third possibility, I think, is that other countries react by acquiescing to the US and saying, okay, you're probably right. We probably kept our tariffs too high for too long. We'll match your tariffs 1 for 1, and we'll proceed that way. And I think that would, or at least on many goods, would proceed that way. Or we set out a timeline to get to that. I could see something like that happen. That would be freer trade eventually around the world. I could see that happening, and I'd put a 45% chance on that. In fact, I think a lot of countries, their optimal reaction here would be to, at least in these first 2 years, is to go in that direction and make deals in that direction. And then they could see if they like that or not, or they could back out later if it wasn't working. So I think there's unpriced possibility there that has, is reasonably high probability that Europe, Mexico, Canada, China react to this whole situation, promising lower tariffs for U.S. products.
So Jim, this is a pretty bullish picture, right? We're a good president coming in who's pro-growth, deregulation, tariffs may simply level playing field, continuation of the corporate tax rates. So you're now in the Fed, or the posture has been anti-inflationary. I mean, sorry, you bring it down, and that's been the stated goal. What are you thinking? Like, are you, if you're like, what would you be thinking now? What your role is?
Mean
like,
the
what is your
wants lower interest rates?
No, if you're thinking about monetary policy.
Oh, okay.
Yeah, like what what would your be of what to do now?
Yeah, I mean, I think policy is actually in a great spot here. They've had this great run where they had really high inflation. They managed to get rid of most of it without the recession. And they've still got a relatively high policy rate compared to where the committee thinks the neutral policy rate would be. According to their recent publications, the median person on the committee thinks the neutral rate is about 3%, and they're well above that. So they can easily make the argument that, hey, we're still putting downward pressure on inflation. We're trying to get rid of the last bit of inflation here, and we expect that to go away only gradually. And they probably only want it to go away gradually because you'd like to asymptote into 2% inflation. You don't really want to overshoot or anything like that. So I think they're in really good shape. And they will be able, I think, in the base case, to lower the policy rate a little bit further as they go through 2025 here, and that's what they've been projecting. So a risk with this is that no, inflation turns around and goes higher, and then they have to raise interest rates again. I wouldn't put a lot of probability on that right now. I don't think that's likely. I think if inflation doesn't behave or doesn't cooperate, I think they'll just keep the policy rate where it is, but they've also positioned themselves to be able to do that. So I actually think monetary policy is in pretty good shape. But the bullish scenario overall, I think that one of the biggest things that's happening is, boy, that's a strong dollar, and you've got a very strong dollar policy right now.
Okay, so let's talk about the fiscal situation in the country and whether that has any effect on this, right? There's a very vocal and powerful wing of the Republican Party that is focused very much on reducing the size of our deficits and even, dealing with our long-term, I would say, our mandates. Who you have this committee of DOJA committee to try to cut discretionary government costs, and and you just have we just inherited a huge debt and an unfunded mandate situation. Just putting that into the mix of things that we've been talking about, how do you think that collectively all that is going to affect what happens in the next if any, or should it affect what's going to happen the next 4 years?
Yeah, I mean, when there's a budget discussion in Washington, usually it's not very. This is all about entitlements and the projected entitlement spending, and about defense spending. Both of those have essentially been taken off the table. So you've really got only a small fraction of controllable spending. And even if you made, what would be considered major strides in eliminating some of that, it would be very tough political battle to do that. So I think people have to, quit talking about cutting even an agency or something like that. It's just small potatoes compared to how big these other categories are, and would come at high political cost and, do very little for the long run fiscal situation. So I think if DOJ is going to do anything successful, they've got to think outside the box. Those guys are pretty good at thinking outside the box. I think, one thing that you could think about is somehow indexing future expenditures to GDP so that you're not spending too much or too little in the future. Instead of promising me an explicit payout of $100 10 years from now, you would tell me that I'll pay you $110 if the economy does very well during that period, and I'll pay you only $90 if the economy doesn't do very well over that period. That would stop this kind of projections of, okay, the spending is going to go like this and the GDP is going to go somewhere else. You want to link those up. Even defense spending, I would say, sure, you can, if you think you need another aircraft carrier, that's might be a fine thing to do. If we have plenty of revenue to do that, then please go ahead and with the aircraft carrier. If we don't, we're not going to be able to afford that, and you're going to have to think about how to defend the country without the extra aircraft. So I think this notion of getting better linkage between the wealth of the nation and the expenditures of the federal government would help us a lot. I don't have any about this. A few other smaller countries have tried things like this and have had some success, I think, in keeping expectations in place about what the government can do or should do over a medium term, 10-year or 20-year horizon. So that's the kind of thing I think has to be thought about. I think if you just talk about, hey, there are too many agencies doing these duplicate things, and maybe we could cut one of them. I think that's small potatoes in this discussion.
Yeah, it sounds like that has more of an effect as opposed to a fiscal effect, right? If it's going to have an effect.
Yeah, I thought it might be outdated, but at least at one time, the federal government had 14 training programs. Every member of Congress loves the job training program. You might say, well, can we just have 7 of those? Wouldn't that be okay? And couldn't we accomplish everything the same way? You might be totally right about that. That would be high political cost to get all that to happen. And how much would you really save in this when we're at a really big picture? So what's going to happen, I think, is that nothing will happen. That's the way it's gone. And so I think that's the best baseline prediction. And people will talk about it, and they'll look at the numbers, and they'll look at how this really works, and then you'll end up with probably just more debt going forward. So is that going to cause a crisis in the U.S.? I don't think so. I think the U.S. has tremendous capacity to borrow internationally, but I wouldn't recommend that we do that we use up even more of our borrowing capacity, but I think that's probably the most likely outcome.
That would be the bet that you would make after the last 30 years, right?
Yeah, so, absolutely.
Okay, yeah. We did 12:35 for there, but maybe I'll just ask one last question. Anything else you want to tell? You think we should know, or you just wanted to?
On immigration, let me talk about immigration and inflation a little bit. So I think a lot of people, again, have tried to make this linkage. I don't think it's a great argument. So let me tell you, this argument has 2 links in the chain that are very weak links. And so you've got immigration itself has certainly been higher in the last couple of years and so on. And people have talked about that. But still, if you look at the immigration part of the labor force, that's a small fraction of the labor force. And so you've got kind of a small number there. Even if you change immigration policy around some, you're talking about small numbers. And then the health of the labor market does have some impact on inflation, but that impact is also minor and a fact that's often overlooked in financial markets. So you're multiplying a small number, the level of immigration in the total labor force, and so that's a small effect, and then you're multiplying that by another small effect, which is the impact of labor market health on inflation. So you're multiplying 2 small numbers together, you get a small number affecting the overall inflation rate. It's not that it isn't there. There probably it may be measurable, but you're probably talking about something on the order of 1/10 or something on the inflation rate, not on the order of 100 basis points or 200 basis points on inflation. So because of that, this has been over-discussed and overemphasized in the discussion. The immigration issue is really all about, is more of a social issue and more of a issue about how should we handle immigration into the U.S. And I have ideas about that as well. But I don't think you should make this policy based on you think there are important inflationary effects one way or the other.
Got it. So I'm told we actually have some more time. So we talked about it for the questions. How about there's a lot of talk recently, and there's been a huge run up in Bitcoin, right? And the seems very interested. He's talked about having a reserve, like a strategic petroleum reserve, except for things like Bitcoin. So I'm sure you have a view on this topic. It seems it's just a big topic. So why don't you let us know your thoughts on it and where you think it's going to.
I think on the Bitcoin reserve, I think any industry worth its salt has gone to Congress and said that they think their product should be stockpiled by the government. So I think that's what's happening. And I don't know if they'll be successful or not, but wheat farmers want wheat to be stocked, and oil producers want oil to be stocked, and everything. So I think Probably the federal government has stocks of various things because of this sort of been argued over the years. I think I guess on crypto I got just two things I would say. One is that it's certainly possible to issue private currencies, and that's what's happened. And but there isn't just one of them. There are about 100 of these virtual currencies that are worth at least $1 billion. So I think a key issue for these guys is to say, what about free entry into this market? There doesn't seem to be anything really to distinguish one from the other. They might be slightly different. Is there a way one of them could gain advantage against the other one, and then everyone switches out of Bitcoin and into something else? So I think this freedom of entry into this space is something anybody that's in the space should think about and might wonder about. Milton Friedman talked about private currency issuance. He was very concerned about it because he said that if you let everybody issue a currency, then everyone's going to issue a currency. And that's kind of exactly what has happened here. And there aren't just 100 of them. There are many, thousands of them beyond that, that don't have near the $1 billion threshold, but they're still out there. So that's free entry is one issue. I think the other issue is that cryptocurrency needs to get a business case, a plain vanilla business case that does not have anything to do with regulatory arbitrage, including international regulatory arbitrage. So if everything that you do is privately issued currency has to do with getting around government constraints of various kinds, sooner or later, the government's going to come and crack down or arrest people or something. So I think you want to get away from that sort of notion that that's mainly what this is used for and what it's good for. And so I think that's a major concern, and has been, to be fair, a major concern of this in this space. So we're still looking for that application. If they hit on that, it might really blow up the success. Extend the success of cryptocurrency, but I haven't seen that application so far.
Great. Obviously, we could talk about cryptocurrency forever too. Anything? Let's leave the open-ended question. Anything else you like tell us you think we should know about the current state of affairs of the political economy and or where things are going?
I would. We have seen this movie before. We saw Trump 1.0. I do think the sequel will be a little different. I think he's far more prepared to be president. I think he's got a team around him that is likely to be pretty stable. One of the things that happened in 2017 was that it was an unstable circle of advisors, and he fired people and hired new people in, and that's very time consuming. It takes a very long time. So I don't think we'll see that this time. I do think that this very narrow majority in the House is almost unworkable. It's not unworkable, but that suggests to me that the Democrats might have a role to play in making some agreements that they could get some of the stuff that they want. I don't know if that's the way this is going to go. Certainly, we've had hyper-partisanship, but this seems like a time, and this configuration politically seems like a time that might be ripe to drive both parties to want to cooperate, even though it seems like they would never cooperate. That just because of the votes and the way everything's going and what the different parties want, you could put sweeteners into bills and get a bipartisan agreement. So we'll see if that happens.
Yeah, I think predicting political activity is just when you think it happens, and when it happens, it doesn't happen.
Yeah,
it's not
exactly
not a base that's on.
Yeah, no, that's what I'm thinking. Yeah.
So, well, great. That's all I had. I really want to thank you. You're the perfect person to have this conversation, and I know I learned a lot. And that's it. I want to thank you very much.
Well, thanks for having me, and I appreciate the opportunity.